Hi, and welcome everyone. We're just going to wait a few minutes for majority of people to join. Thanks for being nice and prompt and early.
Good afternoon to everyone who's just joined us. We're going to hold on a few minutes longer because only about half the attendees have joined. So just to give us a little bit of a chance to allow the others to join. So if you need to make coffee, get a cold drink or whatever it is, now's the opportunity, and we'll come back to you within the next few minutes. So the latest we'll start is 5 past, depending on numbers, but at this stage, we're aiming for 5 past. So do whatever you need to do. I've got my coffee. I'm just waiting for everyone to join. Okay, so good afternoon, everyone. It seems that people are keen to join, so piling in, and couldn't have chosen a better afternoon to do this reporting standards. So, and welcome to Milan van der Wyk, who's going to be running the session. We are going to have there 2 sessions, so there'll be a break between the first and second of about 10 minutes or so, just to allow a comfort break. And if you need to get coffee, cold drink, or whatever it is. But we're ready to go, and welcome everybody, as I said, and enjoy the afternoon. Milan, the floor is all yours.
Thank you, Stan. Thank you, Danny. Yeah, welcome everybody to this afternoon IFRS session. I'm sure it's going to be interesting. I think it's stuff that really impacts everybody. Yeah, it's going to be a nice, engaging, and interesting session, I hope. And yeah, I hope you get full value out of your time that you spent with us this afternoon. Right, so like Stan mentioned, there are two sessions. So the first one we'll talk about IFRS 18. So it's a newly issued standard by the ISB. And then the second session, we'll just talk about the IFRS sustainability standards again. So the second session will not be that long. I'm going to just give a quick overview.
Sorry, Milan.
Yes.
Your sound is coming very soft. Do you want to just check your microphone or lean in a bit more?
I will. Is it better if I do this?
Yeah, I think so.
Yeah, I'm just going to check my audio quickly while we are busy. Sorry about that.
Yeah, okay, that's better, loud again.
Okay.
But it just went soft for a second.
Yeah, I don't know. But anyway, thank you. Thank you for letting me know. Okay, so let's get started. So just a couple of disclaimers and copyright. So I'm not going to read that slide. Okay, so for this session, what we're going to do is we're going to talk about, firstly, the introduction and overview of the new IFRS 18 standard. And then what we're going to do is we're going to cover the key things. First of all, the statement of profit and loss, and then you'll see there are a couple of other subsections under the statement of profit and loss. We will also deal with other elements to the financial statements, and then the management performance measures, which is also something new, and then consequential changes to other standards due to the issue of this new standard. Okay, perfect. So let's get cracking. So why did the ISB change? Okay, so basically what we all know is IS1. IS1 is the standard for presentation and disclosure. If you are an IFRS reporter, a full IFRS reporter, and there were a couple of things that the ISB felt like it didn't work. So the key thing is that the old IS1 standard did not provide enough guidance in certain disclosure matters, and it resulted in a lot of inconsistency in comparability issues in the standards. So what the ISB done is to try and provide more guidance on a principle-based basis, and also to provide guidance on specific matters that's quite new. All right, and I'm going to talk about that in the next couple of slides as well. Okay, so basically what's happened is that IFRS 18 replaced IS1 now. Okay, so IFRS 18 is the new standard that provides guidance on presentation and disclosure matters, and it replaced IS1, but it also has other consequential changes on other standards. So IS8, there's some changes there that I'm going to talk about today. IS7, the cash flow statement's got some changes. And IS33, which is not relevant to you guys, there's also a couple of minor changes there, but I'm not going to address that today. Right, then just something else. So just an additional matter. So IFRS, so the International Financial Accounting Standards, is now called the IFRS Accounting Standards. Okay, so that's just something just to take into account when you're preparing your financial statements. So you don't just refer to IFRS anymore. You need to specify that you are complying with the IFRS accounting standards. All right. The reason for that is because of the second session, that there's also now IFRS sustainability standards. So you need to differentiate between what IFRS standard you are referring to. Okay. Right. So the overview of the standards. So it's issued earlier this year. So it's fresh. It's applicable for periods starting on 1 January 2027. So if you are a 31 December 2027 reporter, that will be the first time that you'll be reporting on it in 2027. And there are a couple of major changes that the ISB has made. So the two key things is that they added two mandatory subtotals, which is your operating profit, so including a specific line item on the statement of profit and loss for operating profit, and then also another line item for profit before financing and other income taxes. Okay, so those two line items are added, and it's mandatory that you need to disclose or present those line items in your statement of profit and loss. And there's also a couple of categories that they have developed now, which will supplement the preparation of the income statement or the statement of profit and loss, which aligns with IS 7, where they basically said now they're going to move towards an operating classification, an investing classification, and a financing classification. Okay, and then also another two classification, which is the income taxes and the discontinued operations. Right. Then are also a couple of limited changes in the statement of cash flows, and also there are no changes in the other, well, not material changes on the other statements. So the statement of other comprehensive income, there are no changes. Statement of changes in equity, no changes. And also the statement of financial position, no changes either. Okay, so the biggest changes are actually on the statement of profit and loss. There's also new disclosures that they require. So the new disclosures are based on, so I just want to quickly just annotate here. So the new disclosures will be based on the management defined performance measures. Okay, so that's a new concept that they brought through, which is quite important. Okay, then something else also that has remained the same is that the disclosures have been carried over from IS1. So a lot of the disclosures are actually the same, but maybe just the placement of those disclosure requirements where they are in the new standard, and also some of them have moved over to IS8. Okay. So what are the main changes? So as I mentioned earlier, so it's the presentation of defined subtotals, like I mentioned, the operating profit and the profit before financing and income taxes. And then also enhance the requirements or guidance on aggregation and disaggregation to provide more useful information. And then also disclosures about management defined performance measures that you need to provide to the use of the financial statements. Okay, so the financial statements. So what are the financial statements? Okay, so a complete set of financial statements in terms of paragraph 10 includes your statement of financial position, statement of financial performance, statement of changes in equity, and the statement of cash flows. So there's also the notes of the financial statements that you also need to include in your financial statements. But what is very important here is that you need to differentiate between what is primary financial statements and also what is the notes. Okay, so the line items there in blue is the primary financial statements, and the purpose of the primary financial statements is to provide useful structured summaries. So the primary financial statement is a summary of everything that's happened, and if you need the detail, then you go to the notes. Okay, it's something that I think has been done in IS1, but it hasn't been defined like that. But it also just provides clarity what the purpose of each of these line items are. Then also what is very important is that in paragraph 11, they talk about the words you can use or the names of each of the statements. So you can use different names. So they will talk about statement of financial position, for instance, in the standard, but you can refer to the balance sheet, for instance, or instead of profit after tax, you can talk about net income or net profit. So it is important that you can use it as long as it doesn't obscure information that you want to present in the financial statements. Okay, something else also is that you still have the two statement option in the statement of financial performance, where you can have the statement of profit and loss combined with the statement of other comprehensive income, or you can have two separate statements. Then also in the statement of financial position, the same principle that you need to show a third balance sheet if there's a change in accounting policy or a restatement in the prior year. Then a couple of general features. So a very important principle there at the top is material information. So it's very important that when you disclose information, that's the material information that you are disclosing and presenting, in order to ensure that it provides useful information that's relevant and that doesn't obscure the decision making or the relevance of that information. Okay. As mentioned earlier, primary financial statements provide structured summaries, it's also important to identify financial statements and to distinguish them from other published documents. And there's other couple of requirements that's pretty much the same as what you would have in IS1. The frequency is at least annually, which is the same as IS1. Consistency needs to be consistent. Comparative amounts need to be there, etc. So there's pretty much the same information there. Aggregation. So this is important. So aggregation is that you can summarize, but you disaggregate items if it's necessary, or if they are dissimilar in the characteristics. All right, and it provides more useful information. You need to disaggregate that information as well. Okay, but there's a separate guidance on aggregation and disaggregation. Then if you talk about offsetting, so the same principle applies. You cannot offset income and expenses and liabilities and assets. Then the concept of aggregation and disaggregation. So this is very important. So additional guidance have been provided by the ISB on this matter. So it's basically how do you aggregate or put things together and summarize it versus, when you need to go and show the detail of those items. So what they say is that you need to classify and aggregate line items based on shared characteristics. So for instance, PPE, everything that is PPE related and falls under the definition will be aggregated and presented as PPE in the financial statements. And then obviously if you disaggregate when characteristics are not shared. So if it's something different. So again, a simple example would be PPE. If you have investment property, it's still a building which can be seen as PPE, but because it has a separate classification and a characteristic, then you present your investment property separate from PPE. Okay. So, and again, it's for the purpose of providing useful structured summaries on the statement of financial position. And also important is that if you need information regarding the detail of these summaries, is that you go to the notes for these summaries. Okay. Then also to ensure that disaggregation financial statements must not obscure financial information. So again, it must be useful to the users and not obscure financial information that is required. Right, so I've got a reflection question that I want you to do. So there you'll see there's a QR code on the screen there. And I will go to that separate website just now. So there's a question I want to ask you there, and you must just say true or false. The notes to the financial statements form part of the primary financial statements in terms of IFRS 18. So just whether you say it's true or whether you say it is false. All right, so please scan the QR code. And then I will just go to that separate site just to see what the results are of your attempt. Get there. Okay, so we'll go to Mentimeter. And you'll see the...
Malone, I don't know if anyone else is having a problem, but I know when I'm tried to load it, it's just, okay, I see people have been replying, but when I tried it, it was just hanging.
Okay, now maybe it can be a bit slow, but also if you're struggling with the QR code, there's also a code that you can use there on the screen. So just what you want to, if you want to use that code 37644107, and then you guys can yeah, still answer the questions there. All right, so I see 5 people answered, all 5 of them say it's true. Okay, so I think this is a moment where I can just quickly teach as well. But if, yeah, I'm just waiting for some comments there also, or more responses. And I think it's important also that if you have used this code here, you'll see there's other questions also. So once you've joined on this code, just keep your screen open on that, because I'll go back to the questions on the next questions again. All right, I see there's a couple of thumbs up there also. Great stuff. Okay, see 7 people has answered. Okay, so if I go to the, just to take it back again, so the notes of the financial statements, it is part of the financial statements, yes, but the primary financial statements is not part of the primary financial statements. Okay, it's actually a secondary part of the financial statements. All right, so remember, if I go back to the slides, the primary financial statements consist of your statement of financial position, statement of financial performance, statement of cash flow, statement of changes in equity. Okay, those are the ones. That's the primary financial statements, and the notes to the financial statements are secondary. All right, where you'll find the detail. Okay, great. Okay, so I'm going to go back to the slides. I'm just going to go back here. Okay, we're going to go through that exercise again a bit later. All right, so I'm going to move on to the statement of profit and loss. Okay, so what needs to be presented in the statement of profit and loss? All right, so this is basically the same information that has been required in the past as well. Okay, so the paragraph reference is different. All right, IS1 has got a different paragraph, but it's the same content basically included in the required line items. Okay, so it's your revenue, your operating expenses, the share of the profit of associates, your income tax expense or income, and also your discontinued operations. Okay, so that's basically the 5 things that you need to have there. And also a couple of IFRS line items, IFRS 9 items that you also need to have there: interest revenue, impairment losses, gains and losses from derecognition of financial assets, gain and losses arising from reclassifications, then also, yeah, a lot of financial instrument line items there. Okay, and also amounts required by IFRS 17 as well. Okay, for those that are in assurance. All right, then very important then is that, you know, and this is one of the big or the key changes in the statement of, or in the IFRS 17 standard, is that your statement of profit and loss have now got 5 categories in the manner in which you present it. All right, so you've got your operating category, you've got investing line items, you've got financing line items, you've got your income taxes, which is a simple one, and then also you've got your discontinued operations. So the ISB has provided some guidance on how to approach this, and that's the core of this session, is to go through all of these categories as well. Okay, so basically, if you look at a statement of profit and loss, so if you look at a general company, so this is not a very specific company like a manufacturing or a bank or anything like that. So if you look at the line items, okay, if you look at the subcategories, all right, you've got your gross profit there, but very important there is that you've got your operating profit. So if I can just quickly annotate here again. Okay, so there, if you can see your operating profit line item, so that's new, and also your profit before financing and income taxes is also new. All right, and that basically creates these categories there. All right, so anything above the operating profit line is your operating income and expenses. Okay, and then you've got after your operating, but before your financing and income, you've got your investing income and expenses. So that's your share in profit of associates, also your investment income and rental income and those type of things. Then after that, you've got your financing category. Okay, that's your debt instruments, your interest expense, and all of that on your debt instruments. And then finally, well, then you've got your profit before tax, and then your income tax line. And if there's also discontinued operations, there will also be a line item for discontinued operations after the profit for the year. Okay, so this is just a basic illustration of the different categories that's there, and I'm going to unpack it as we go along. But this is this for me is the crucial thing that will change going forward for all companies. Right. So the easy one, or the easy two that I'm going to quickly just talk about is the income taxes and discontinued operations. So this basically stays the same from IS1. So any income taxes from IS12, the resulting taxes, you have a separate line item for that, and also include your foreign exchange differences on that amount as well. Then for discontinued operations, so any well, it will be a single line item in terms of IFRS 5 that you go and present, and that you need to satisfy the requirements of IFRS 5 to account for discontinued operations. Okay, so those are the easy ones. But the other ones has some nuances, right? So the categories of the statement of profit and loss depends on whether entities have specific main business activities. Okay, so what does that mean? Specific main business activities is that, yes, you're a company, but you have specific things that you do that makes you different from a general company. All right, a great example of this would be insurance companies or banks, or even retail or real estate companies, not retail companies, real estate companies. Okay, so they are very specific in how they operate their businesses. Okay, and that's where you will have some nuances in terms of the categories. Okay, so for instance, you might have a line item under investing, all right, as a general rule or principle, but because of the nature of the company, that specific income or expense can move out into an operating category. Okay. An example of that would be, if you have interest on loans, right, usually that will be an investing category. But because if you have a bank, for instance, that is in the business of granting finance or providing finance, that income and expense will then move to operating. Okay. The same principle then applies also for financing. So something could stay in financing as a general principle, but because of the main business of a particular company, it can move up to operating. Okay. So this is an important slide. Okay. Then another important slide is also what happens now with exchange difference, foreign exchange differences. Okay. So the easy way of explaining this is that whatever happens in the category on the income statement or the statement of profit and loss, the effect of the foreign exchange difference will be the same. Okay, so for instance, if you have exchange differences on receivables or for sale of goods, it would be operating. Okay, and therefore the exchange differences will also be operating. Cash and cash equivalents would be investing. Exchange differences on foreign currency denominated debt issued would be financing. And exchange differences on income taxes will go to income tax. So it's a whole truck and trailer principle of where the exchange difference originates. It will follow the same category in that regard. Okay, so there's another reflection question. Okay, and again, the same QR code. So if you haven't participated in the previous one, you can participate in this one now. Same QR code, same code. So there's a separate question regarding the main business. So the main business activity of an entity can determine the type of category and income and expense will be classified as in the statement of profit and loss, true or false. So I'm going to quickly just go up here, back to the Mentimeter slide. Just go to my following, the next slide. Okay, so the main business activity can determine the type of category an income and expense will be classified as in the statement of profit and loss. Okay, so there's a question there. So do you agree or do you disagree? I see one person answered there. Yeah, 2 people answered. 3 people, all of them agree. 4 people. Guys, so I just want to make sure that we get some interaction here. So 5, 6, 7 people. Okay, there's also. Okay. All right. And again, I'm asking if you agree, because it's not about what the standard says, it's also what you think is right. So if you feel like, no, but this is not how it should be, then you can say you don't agree with it. All right. It's not a test where I'm gonna say you got 0 out of 5 or whatever. All right. Okay, but it seems like everybody says they are in agreement with this. So that the main business activity can determine the type of category income and expense will be classified as. Okay, and it makes sense. So if you are a bank, there's no sense in having interest income as a financing activity because it's part of your core operations. Okay, then let's move on to the next one. Okay, just give me a second here, guys. Sorry. Apologies. Yeah, I'm working from home and I just had a quick crisis just to sort out. So apologies for that. Okay, so I'm just going back to the slides. Right. So let's talk about the operating category. So this one's also not too bad. So the operating category is basically anything that doesn't fall into the other categories. So if it's not a financing category, if it's not an investing category, if it's not an income tax, or if it's not a discontinued operation, it will fall under operating by default. Okay. So that's important. So it almost tests for all the other ones. And if it doesn't fall into the other ones, it will be operating. Okay. So, and very important, the manner in which you go and present the operating incomes and expenses. So again, very similar to IS1. So you've got your nature and you've got function, right? So you can have your income and expenses by nature. You can have income and expenses by function, but you can also have a mix of the two. Okay, which in IS1, it wasn't that clear. A lot of people did have a mix, and there was some blurred or gray areas in that regard. So what is important here is that now you can actually mix it. You can have both classifications as part of your statement of profit and loss. Okay, so if you move to what type of disclosures you also need to present. So I'm just going to quickly annotate here again. Okay, so the hotspot is there. Right. So if you are classifying according to function, so you're basically saying some expenses will be operating expenses, some expenses will be distribution expenses, some of them will be marketing, some of them will be cost of sales. I think it's the ISB then also requires you to provide additional disclosure to explain what makes up these classifications, right? And they will do it according to specific line items. So in a single note, you will disclose then the reconciliation from depreciation to those items classified according to function. So you will have depreciation in there, what makes up the amortization, what makes up employee benefits and share-based payments, what makes up impairment losses, and also the write-downs of inventory. Okay, so the easiest way to illustrate it is by looking at what the ISB proposes in terms of a disclosure. Okay, and this is what they basically want you to do. So what you can see there is that, for instance, if you have a classification for cost of goods sold and research and developmental expenses and general admin expenses, how does these classifications tie up to your total depreciation charge for the year. Okay. And same with amortization. What makes up the amortization charge for the year? And same with employee benefits. If you have total employee benefits, what goes to cost of sales? What goes to selling expenses? What goes to research expenses? So you need to show this reconciliation then as an additional disclosure to your financial statements, okay, to explain what these classifications or these functional categories are. All right, so I hope this makes sense. So maybe if you can just give me a thumbs up if you see it makes sense. If it doesn't, then I'll just explain again. But this is important disclosure. I think it's very important that you do understand that you provide this disclosure in addition to your statement of profit and loss. Okay, then if you look at, again, a multiple choice question, a reflective question. Okay, so I'm going to go back again and ask you to complete this. So the question is, operating expenses can be classified according to nature, function, both nature and function, or according to business activity. Okay, so let's just see what your answers are on that. So I'm going to go back here. Okay, so you'll see there's a separate question for this. So operating expenses can be classified according to, and you can just choose one of them. All right, I don't think it's select a specific, select all. You can't do that, so you need to do one. All right, I see people answering there. Thank you for that. Okay, all right, I see 5 people have answered there, and all 5 of them have said both nature and function, and that's correct. Okay, so that's very important. So in the past, we had nature and we had function, either or. Now you can have a mix of both of them. All right, so you can have either just nature or just function, or you can have a mix. Okay, right. So we're going through this quite quickly. All right, so I'm making good headway. So I'm just going to quickly go back to the slides. All right, so if we move on to the next slide. There we go. So now we're going to speak about the investing category. All right, so investing is basically, the income and expenses that you get from investments that you've made as part of your business. Okay. And what is the principle in the standard? So paragraph 53 talks about a specific issue. So it says there, except for an entity that has a specific main business activity, for example, financing or banking, an entity shall classify the investing category income and expenses specified in paragraph 54 from these 3 categories. Okay. So these 3 categories, if your income and expenses falls into these 3 categories, it will be an investing income or expense. Okay. So category 1, so investments in associates and joint ventures and unconsolidated subsidiaries. Okay, so that's basically consolidation category basically. The second one is your cash and cash equivalents. And the third one is your other assets that generate a return individually or largely independent of the entity's other resources. And a good example of this would be debt instruments that you invest into. So maybe you invest into debentures or preference shares, or it can be investment into investment properties. All right, so if you hold investment properties as part of your business, that will also then be your category 3. All right, so those 3 categories will determine whether whether income or expenses will be regarded as investing income and expenses. Right, so moving on to the next slide. So what type of expenses will there be? All right, so it can be your interest expenses, it can be dividends that you receive from investments, it can be rental income, it can be depreciation, if there's investment property measured at the cost model. It can have impairment losses or reversal of impairment losses. It can have fair value gains and losses. And then also income and expenses from the derecognition of an asset or its classification and remeasurement as held for sale. Okay, so there's a list of items that can form part of the expenses and incomes in the investing category. Okay, and these will then relate to those three categories I've mentioned earlier. Okay, so the important thing here is also now to say, okay, what if these categories fall into a main business activity? Okay, so for instance, if you sit with a bank, what will change? If you sit with a real estate company that like a Redefine or Atterbury, you know, what will happen? You know, will it look the same? And this is what the ISB has given us to help us with the guidance on this matter. So if you have income and expenses that is from the category 3, from asset that generates return individually and largely independent of the company's other resources, so typically like a investment property, okay? Usually this will be an investing income and expense, okay? However, if this investing is then basically in the asset, is it part of the main business activity of the company? All right, so for instance, investment property. If investment property is part of your main business activity, then it will not be a part of investing. It will go to operating. It will be an operating income instead of an investing income. So if your answer is yes to this question, you move it out of investing into operating. Okay. The same principle applies then to investments in subsidiaries and associates and joint ventures not accounted for using the equity method. All right. So if it's not used, if the equity method is not used, you apply the same principle. You ask yourself, is it the main business activity to invest in these items or these subsidiaries? If yes, there will be an operating income or expense. All right. If no, then will be an investing income or expense. Okay, and then the third one is an interesting one. Okay, so the third one is when you actually equity account. Okay, that's very important. So if you have investments in subsidiaries and joint ventures, but you equity account for it, then you don't have this option. It will always be an investing activity, all right, or investing income and expense then. All right, so the gains and losses or the profit that you make from your associates, that single line item will be an investing profit. Okay. And yeah, I see there's a question. All right, so maybe I see there's a couple of hands raised. So maybe if you want to ask a question, you can quickly ask a question. Danny, if you want to unmute them.
Okay, I've unmuted Linda. If you want to talk, you say, because you just have to unmute yourself as well. I've just allowed you access. Don't know if maybe they were just putting up their hands just to note, like say that they'd seen your question earlier where you said put thumbs up if you agree. I'll ask
it could be that, yeah. It could be.
Yeah, I'm just gonna lower their hands.
Question, yeah. If you have a question, also maybe you can put it into the Q&A box, and we can just park or the chat, and we can park it and then answer the questions later. Perfect. Okay. Good. So just to recap here. So if you have an investment in subsidiary or joint venture or associate that's equity accounted, then it will always be regarded as an investing activity. Okay, very important. Okay, let's move on to the next one. So the next one is cash and cash equivalents. So what happens with cash and cash equivalents? So again, the starting point would be that it would be investing incomes and expenses. So your interest that you earn on the cash and cash equivalents will be investing income. So interest received on your cash or your deposits will be investing. So it's not an operating item. So they say there that, or they give you a couple of questions firstly. All right. So if the company doesn't have a main business activity, okay, then you say all the income and expenses from cash and cash equivalents will be an investing category. Okay. Then if you have a business activity, there are two things that you need to consider. Okay. So the first question is to ask yourself, does the entity invest in financial assets, okay, as a main business activity? Okay. If the answer is yes, they invest in financial assets, so it's an investment company, then the cash and cash equivalents the income from cash and cash equivalents will then be regarded as an operating activity. Okay. So you go down to this line here. Okay. Operating activity. If the answer is no, you have a second question you can ask them. Then you can ask yourself, does the entity provide financing to customers as a main business activity? Okay, so if they are providing finance, it's a bit more complex. So you can either say, okay, I ignore it. Oh, sorry, if you don't provide financing, you fall back to investing. But if you are providing finance to customers as a main business activity, like a bank, then what you will do is you'll have an accounting policy choice for either the income, for all the income and expenses from cash and cash equivalents, or a portion relating to the actual activity. Okay, so you can take all of the cash and cash equivalents, the incomes and expenses from that, and show it as an operating category, or you can go and say, okay, only the portion that relates to the main business activity, go and take that to operating, and the rest will remain in investing. Okay. So this is important. So I think the cash and cash equivalents one is probably one of the tougher ones to go through and to ask yourself. Okay, then reflective questions again. All right, so there's another question. So the fair value gains and losses on investment property for real estate entities will be presented under which of the following categories? So under nature, investing, financing, or operating. So I'm going to go back to that other site. Okay. So again, fair value gains and losses on investment property for a real estate entity will be presented under which of the following categories? Okay, so you guys can please answer that for me. See, it's coming through. I think what is important here again is to understand what is the main business activity in this case. Okay, I see about 7 people have answered here. I keep it open for another couple of seconds while I talk. All right, so it's definitely not nature, all right, and it's not financing. So for me, it's about whether it's investing or operating, okay, because the fair value gains and losses comes from an asset that you've invested to that has cash flows that's largely independent from the other elements of the financial statements. Okay, so the answer here should be operating. Okay, so everybody, all those that have answered were correct. So it is an operating income and expense. If you have a business that, like a real estate company, where you invest into investment properties. Okay, so that's well answered by everybody. Okay, so let's move on back to the slides. Right. Just going to get the annotation ready again. Oh, there we go. Okay, so moving on to the financing category. So the financing category is a little bit easier than investing. So again, you need to determine what income and expenses will be classified as financing. And there's specific paragraph that again talks about 2 categories or subcategories that you need to refer to. And that's in paragraph 59. So the first one is when you have liabilities that arises from raising finance. Okay, so again, typically a bank. Okay, so if you have liabilities that arises from raising finance, that's category 1. And then everything else will be your other liabilities. Okay, so that can be provisions, it can be contract liabilities in terms of Ifrs 15, it can be insurance liabilities. So it's different, it's anything except for liabilities that arise from the raising of finance. Okay, so let's have a look at what needs to happen here. Okay, so what are the examples of incomes and expenses that from the liabilities from liabilities raising of finance? So firstly, it's interest expense. So basically amortization. So if you have debt instruments that you've issued, your interest expense would then be one of your main expenses on that instrument, a part of the amortized cost measurement. Also, if you have fair value gains and losses, so if you have a liability that you've designated as fair value, then the fair value gains and losses will also follow the same approach. Dividends on issued shares classified as liabilities, okay, then that will also be part of your financing category. And then also, if you have a due recognition of liability, any expense or income from that will also fall under financing. Okay. So if I break that down a little bit more, so sorry, if I go further to the second category, if you look at all the other liabilities, okay, so any other liability that you might have. So if you have interest expense on payables, it will fall under your category 2. Okay. Also, interest expense on contract liabilities, same thing, will be category 2. Lease liabilities will be category 2. If you have interest on your defined benefit liability, if you apply IAS 19, and if you have a defined benefit plan there, you will also take that as part of your financing category and under your category 2. And then also, if you have a long-term provision and there's a discounting effect on that long-term provision, same thing applies there again. The unwinding of the interest on that long-term provision will also be under your category 2 and therefore treated as a financing activity. Right. So category 2 is a simple one. Okay, so anything that's not the raising of finance, all right, so anything else will be any expense that you have there, interest, or any other transactional expenses will then be regarded as financing category. Okay, so that's category 2. Then if you look at category 1, so again you ask yourself, what is the main business activity? All right, so if the main business activity is something different, then you need to go and concentrate. So they say income and expenses from liabilities that arise from transactions that involve only the raising of finance. Okay. So then you ask yourself, is it for customers or is it for anybody else that's other than customers? Okay. So for customers, then it would be an easy choice. So if you're raising finance related to providing finance to customers, then it will be operating. Okay, so that's the easy one. All right. But now if you raise finance for other than those related to providing finance to customers, so if you have raised finance, but it's not necessarily relating to the customers, then again, you've got an accounting policy choice. Okay. to say that, okay, I'm going to take all of it as operating, or I'm going to take all of it as financing. Okay. So this is, again, a very important principle that one needs to apply. Okay. All right, so this slide should be actually on the next one. So I want to go back to a reflective question before I show you the summary. So again, the reflective question is a bank would and then ask yourself, true or false? A bank would ordinarily classify interest income from loans granted to customers as investing activities. Okay, so I'm going to go back again to that site. Right, and there you'll see the question again. A bank would ordinarily classify interest income from loans granted to customers as an investing activity. Do you agree with that, or do you disagree with that? I see there's a couple of people answered already. Okay, 4 people. Okay, and it seems like if I look at what has been answered there, I know it's only a few people, but what I'm seeing there is that most people say they don't agree with that, which means is that, yeah, it shouldn't be an investing activity, but rather an operating activity. Okay, so yeah, so that makes sense. All right, so I see a lot of people say they do not agree, and which is perfect. Okay, right. Okay, so I'm just going to go back to the summary of the first bit that I've spoken about. So I'm just going to go back here. All right, so if you look at the summary of what I've discussed up until now, and the summary is actually for everything, but I'm just going to go through a couple of things now already. So the big thing is here is that there are 2 major, a couple of key changes here in IFRS 18 regarding the statement of profit and loss. So the statement of profit and loss has got new subtitles: the operating profit and the profit before financing and income taxes. Okay, so that's very important, but also the classifications that we've spoken about now. Okay, so those are the key changes on the statement of profit and loss. Okay, then there aren't a lot of changes here, right, on the statement of cash flows and the balance sheets. All of that is quite easy. Okay. Very important also is if you look at primary financial statements, it's useful structured summaries of the company's assets, liabilities, equity, income and expenses, and cash flows. So on this side, we speak about the primary financial statements, okay? And on this side, it's the notes. So what is in the notes? And very important here is that there must be a connection between the notes and the primary financial statements. All right, so I'm not going to talk about the notes now. There's firstly a couple of illustrative examples I need to go through with you and to explain the classification once again for particular companies. Right. Okay, so let's have a look at the illustrative examples. Apologies for all the coughing and stuff. I think the allergies and everything in the pollen in the air makes it difficult for me at this time of the year. But I'll manage. Okay, so all right, so if you look at what you see on the screen there, so this is just an example of a statement of profit and loss and a statement of comprehensive income. So the statement of profit and loss is on the left-hand side, with the statement of comprehensive income on the right-hand side. Okay, so for the statement of profit and loss, it's important here to notice that the classification here is done by function. All right, so everything there that you see is the function of the expenses. So selling expenses, operating expenses, research and development expenses, general admin expenses. And yeah, some of them, like the goodwill impairment loss, is actually by nature, but I think because of the significance of the balance or the line item, they've shown it separate from anything else. Okay, then there's also other operating expenses also shown. Okay. Right, so what I want to show here is that if you look at the first one, anything above the operating profit line, the subsection there, anything on top of that in the blue here is that is the operating income and expenses. Then anything below the operating profit line, but before the financing and income taxes, you've got your investing category. All right, and here you can see the line item there. They say it's a share of the profit of the gains and losses on disposal of associates and joint ventures. Okay. So yeah, so that's the second category. Then a third category is then after before financing and income taxes, you've got your financing category, which is interest expenses on borrowings, and then interest expenses on pension liabilities and provisions. So this is just an example of what would be there. Okay, so there can be other interest expenses as well. And after that, it will take you to profit before income taxes. Okay, and then after that, you've got your income tax expense, which will take you to profit from continuing operations. But if you have any discontinued operations, you need to have a separate line item for that as well. Okay. Then the remainder is actually very similar to what IS1 has required you to do. So you need to attribute your profits to the owners of the company, all right, the owners of the parent, but also to what goes to your non-controlling interests. Okay, so those two there needs to be, or the non-controlling interest needs to be separated from the owners. Okay, then also your earnings per share, basic and diluted, from continuing and discontinuing operations that you also need to disclose. Okay. For this type of comprehensive income, I'm not going to go through the detail there because it's pretty much the same as what you would have had in IS1. Okay, so let's have a look at this second example. So now you can see this is the presentation is done by Nature. So here you can see it's a manufacturing entity, and now you can see there's no cost of sales line item. So now you can see they just show you the nature of the expenses that they have in the accounting records and in the statement of profit and loss. Okay, so again, everything on above the operating profit line is your operating incomes and expenses. Then below that, you will have your investing income and expenses, and then you've got your financing income and expenses, and then you've got your income tax, and if relevant, then you will also have your discontinued operations in there. Okay, so just want to also just highlight here is that remember, if you go by function, is that if you have these classifications that they're showing there, you will need to go and do that reconciliation to your depreciation, to your income, your employee benefits, to your amortization. So you need to go and show the actual amount and how it ties into the actual charge for depreciation for that year. Apologies, everybody. Okay. And I've done this one, so I'm not going to go through the detail there again. So now the third example. So if you have an insurance company, okay, so the insurance company that invests in financial assets as its main business activity. So now there's a main business activity here. So again, your incomes and expenses by nature. So the first one is your operating income and expenses. Okay. So very important here is that here you can see there's some investment incomes, investment income line items and insurance revenue, insurance service expenses. But that investment income line item is very interesting because it says investment income, but because it's the main business activity of the company, it will actually be an operating activity. Okay. Then the operating profit, after that, you'll have your investing activities. And then after that, you'll have, again, your financing activities. and your income tax expense. So very important here is that your investment income, because the main business activity is investing in financial assets, the income that relates from that you will show as a operating line item and not an investing line item. Okay, I hope that makes sense. Okay, if you look at the next example, so again, the expenses are by nature, and now you've got a statement of profit and loss for an investment and retail bank that invests in financial assets and provides financing as its main business activity. So again, this is pretty much a bank that you would see, your ABSAs, your First Rand, your what do you call it, Stan Bank, everybody. So again, how will this look different now? Okay, so again, your line item on top of operating profit, or everything there, the group there will be your operating categories. Okay, so here you can see that a lot of interesting things. So there immediately you can see interest expense and interest revenue there at the top. So net interest income, fee and commission income, fee and commission expenses, trading income, investment income. So there's some interesting ones there as well. And anything on top there is your operating activity. Okay, your investing activity will then be associated with your share of profit and associates and joint ventures. Okay, and if you have any interest expense, there should actually be a separate or another line item in between here. Your interest expense on the pension and lease liabilities will be a financing activity in this case. All right, so that should be actually a different color, and there should be a different there should be a line item in between here as well, stating that it's your profit before financing and income taxes. Okay, and then the final one there would be your income tax expense, and again, depending on whether you have discontinued operations, you'll have a separate one for discontinued operations after your profit for the year line item. Very important that investment income is shown as an operating line item, as well as your interest will be shown as operating instead of investing and financing. Okay, so now the same information is provided, but now it's by function. Okay, so now you can see it's again, it will look different. So now I can see the incomes and expenses are based on function. And again, the interesting thing here is that your interest expenses and incomes will be sitting under your operating line items. Okay, once again, and your interest from other loans. Okay, so if you just read the line item, interest expense on borrowings not related to providing or financing to customers, they have disclosed that as a financing activity or financing income and expense. Okay, so that's just to show the difference between interest from the raising of finance for the purposes of raising finance to customers will be operating, and anything else will then be your financing expenses. Okay, and again, just to highlight that you have the operating items above your operating profit, and that you have your income from investments underneath the operating profit, but before your profit before financing and income taxes, and then your financing activities for interest from other your interest relating to other loans and other liabilities that you might have on your financial statements. And then again, income taxes is a separate line item. All right, so I'm going to be busy. This is almost the final section of the first session. All right, so I know I've been busy for more than an hour now. So I just want to ask you to hang on tight for another 20 minutes or 30 minutes or so, and then we'll have a nice 10-minute comfort break, and then we'll start with the second session. So, but this is very important, so please listen in, and hope, if you have any questions, please ask me. Okay. Right, so management defined performance measures. So this is again something that's brand new, and it results in additional disclosures in the notes of the financial statement. Okay, so what is a management defined performance measure? Okay, it's a subtotal of income and expenses. Okay, so it's basically, if you look at the income statement, you will have a separate line item on top of your operating profit to talk about profit less capital items, or profit, normalized profit, or normalized earnings, or normalized operating profit, or whatever you want to call it. All right, it's something that's not defined by IFRS, okay, and it is something that presents the views of management. Okay, but let's have a look at what the definition is. Okay, so the definition is that it's a subtotal of income and expenses that is used in public communications outside the financial statements. It's used to communicate management's view of an aspect of a financial performance. And then lastly, it's not listed in paragraph 118 or specifically required by IFRS to be disclosed. Okay, so it's anything that's not an IFRS defined metric. Okay, so then there's a question, is EBITDA an MPM? Okay, and if you read some of the literature regarding the management defined performance measures and what the ISB has issued, they say because EBITDA has got very different schools of thought, and it's not clearly defined, and people have different ways of interpreting EBITDA and whether it really is something that you can work on. They haven't included that as operating profit, because operating profit, for instance, is something that's defined by IFRS. So they say operating profit is this, this, this. EBITDA is not exactly that. Even though people use EBITDA as an operating profit proxy, it is not the same thing. Okay, so what the ISB has said there is that EBITDA actually is then a management defined performance measure. Okay, depending on how management has seen and calculated EBITDA, because people calculate EBITDA in different ways. Right. So let's have a look at what is a management defined performance measure. And there's again a nice decision tree to determine when something would be a management performance measure or not. Okay, so firstly, you ask yourself, is it measured as a subtotal of income and expenses? If you answer no, it's not an MPM and it doesn't require anything to do. All right. If you answer yes, you go to a second question. You go say, is this measure used in public communications? Again, if it's not used in public communications, then you don't do anything. Right. If you say yes, then you ask a third question. Is it included in your list of subtotals in IFRS 18? If the answer is yes, again, you don't need to do anything because it then is not an MPM. Okay. If you answer no to the last one, then you ask yourself, does it communicate management's view? Okay, and this is maybe a tricky one. So if it is yes, there is an MPM and you need to have separate disclosures on top of what you, to show the reconciliation between the IFRS numbers and the MPM. Okay, so that's the easy one. So if it doesn't communicate management view, there's a reasonable and supportable information to, so the question then is there reasonable and supportable information to rebut the presumption? Okay. If there is not an MPM. But if there isn't, then you say it is an MPM and you need to provide more disclosure. Okay. And you will see there's an asterisk behind the management view. Okay. So if it is communicated in public communication, all right, it is presumed that it is management's view if it's communicated in that way, all right, because why will it not be management's view? So that is basically leading towards that, you know, if it's publicly communicated, it will most likely be an NPM. All right, because it will share management's view on a particular matter. Right, so this is an example of a listed company, and a very prominent listed company that I just did some research on. So here you can see, this is the financial information for 2022. And then there you can clearly see, and this is public communications, all right? And this also is something that they have disclosed in the financial statements as well, or presented in the financial statements. So here you can see normalized versus statutory results. So immediately when you see that, it means that there's a different view on the IFRS numbers and what they see as relevant. Okay. So here you can see for the statutory year end, there you can see there's operating items there. Okay, so we've got operating profit before capital items. Okay, again, it's their own definition that on its own. Then you've got capital items. Now, I don't understand really what that line item means, but then you also have operating items after capital items. And then you've got your profit before tax, taxation, profit for the year. So this is a funny line item in the financial statements. Okay, then they also show what is non-recurring and what is recurring, and there's an insurance element to it. And then there you can see the adjustments made to get to normalized earnings. Okay, so there normalized earnings already tells me that there's an adjustment that needs to be made. Okay, and this everything here is outside the financial statements, which is important. Okay, and IS1, it's fine because IS1 doesn't have a requirement for additional disclosure, but for IFRS 18, this would require additional disclosure. Okay, so what are the disclosure requirements? This is just an example. So here you can see, this is basically what the IFRS numbers say. So this is your operating profit, this is your profit from continuing operations, and your NPM is probably defined what it is. And what you need to do is you need to reconcile from your operating profit to your NPM. Okay, so there you can see there's an NPM. IFRS says it's 57,000. The NPM says your adjusted operating profit is 65,100. And how do they get there? They reverse the impairment loss, they reverse restructuring expenses, and they reversed gains from disposal of property, plant, and equipment. Okay, so basically saying that this is once-off items that they are reversing out. Okay, and you need to show the income tax effect of that. Okay, and sorry, just need to get to the right slide here again. And you need to show what the after-tax result also is. Okay, and also how it affects your normal profits, but also your NCI profits. Okay. All right. Then, if you look at the disclosure once again, so there's a couple of things also, not only the reconciliation, but you also need to add additional disclosures. Okay. So the disclosure for management defined performance measure needs to have full things. So the one that we spoke about now is the one there on the left top-hand side. So reconciliation to the most directly comparable specific subtotals. So that would be your profit before tax. It would be your profit for the year. It would be your operating profit. So those are the ones that you need to reconcile to, and you need to show that reconciliation. Okay. But you also need to explain of what the NPM calculation is and how it provides useful information. So why is the NPM so important that you have provided that in your financial statements and that you deem to deviate from the IFRS measure? Okay, so you need to explain that. Then you also need to add a statement that the NPM provides management's view and is not comparable to other entities. Okay, sometimes it will be, but sometimes you have a situation where it completely is not comparable, and then you need to say why that it is not comparable and why it's basically management's view. Then the final one is an explanation of and reasons for changes in NPM. So maybe in the first year you use a normalized earnings as a NPM. Then in the following year, the year after, now suddenly you change it to normalized operating profit, whatever. So why did you make this change? So you need to go and explain. Why did I move from one year to another? All right. Why is that useful information? Okay. And what necessitated this change from one year to the next? Okay. So that is also very important to discuss. Okay. So we're going to go back to a reflection question again. So again, it's a multiple choice question. So I'm asking, which of the following performance measures is a management determined performance measure, an NPM? And I gave you 4 there. So I'm going to go back to that platform, and hopefully we can get some answers there from everybody. Okay. So I'm just going to repeat the question here. Which of the following performance measures is a management determined performance measure? Okay. All right. So again, very, very easy. I see people are answering already. So is it profit before tax? Is it operating profit? Is it normalized earnings? Or is it net profit? Okay. And the easy answer here is that, it sticks out that it is everything else here, that what you're seeing there is quite standard and what you would see in IFRS. Even operating profit is defined by IFRS 18. And now the only one sticking out really is your normalized earnings. So your normalized earnings would be the one that's is regarded as an NPM, and that will result in additional disclosure as mentioned earlier. Okay. Good. Right, so I'm going to head back to the slides. So making really good headway here. Just going to go back here. There we go. All right. So I'm going to quickly just talk about the other consequential changes to other standards. And yeah, so this is a difficult one because I have covered the basics like your IS 7 and your IS 8. But there can be other unintended consequences to other standards which I don't cover necessarily. All right, so you can look at your IFRS 15, you can look at IFRS 9 if there's any changes there. But I think what is important here is that you need to understand that there is basically a ripple effect of the IFRS 18 standard to other standards. All right. Okay, so let's quickly talk about IS 7. Okay, so IS 7. There's also a separate project of the ISB on IS 7 because I think the statement of cash flows is currently not working, and they're working on a updated framework to apply to cash flow statements. So this will probably change in the future again. But there are changes to harmonize with IFRS 18 and the new standard of IFRS 18. Okay. So just want to quickly get my annotation here. All right. So the first one here at the top is that operating profit and loss, the subtotal for that would be used for the starting point of the indirect method, all right, for reporting operating activities, okay? So important here is that in the past, on the old IS 7 referred to profit before tax, and now this refers to operating profit, okay, which makes more sense if you use your operating profit. Okay, so that's a subtle change, but a big change in the indirect method. Then in terms of the cash flow, so specifically dealing with your interest received and paid and dividends received and paid. So again, if there is an entity without a specific main business activity, you need to disclose interest as investing, interest received, interest paid as financing, dividends received as investing, and dividends paid as financing. So basically, they've done away with the accounting policy choice for these line items. Okay, so now they say you must put it under these activities, and it will assist with comparability on the statement of cash flows. Then if the entities have specific main business activity, okay, so then these items will fall under either operating or investing or financing. Okay, it will be a single activity and most likely will fall under operating if it's the case. Okay. Dividends paid will remain as a financing activity regardless. So there's no way that you can argue that this would need to go to operating at all. Okay, so dividends paid will be a financing activity. Right, then main changes, some additional main changes, or not additional, so the same, but I'm just going to show it a bit differently. So like I mentioned in the previous slide, is that your starting point for your indirect method would be operating profit and not profit before tax anymore. All right, so that's the on top here. If you look at the statement of cash flows, that change there is the first one. All right, then your interest received and paid and dividends received and paid. And again, like I mentioned earlier, so now you need to go and it will fall under specific requirements. So anything that you've received, dividends and interest received, will fall under investing, unless it is a specific main business activity. And same thing with the interest paid and dividends paid, it will be financing unless there's a main business activity, with the exception of dividends paid, which will always be a financing activity. Okay. All right, and basically what I've said here is also just explained again. All right, so I'm not going to go through the detail here, but the big thing currently with the changes is that they wanted to harmonize IAS 7 with IFRS 18's changes. All right, so and to keep it consistent with IFRS 18. Then what is very important here is that, again, if you have a main business activity, you need to apply yourself to the principles in IFRS 18. Okay, so that's very important. So there's a couple of examples. So I'll quickly just talk about example 1. So example 1, if an entity classifies all its interest and expenses in the financing category of the financial statement of profit and loss, in the statement of profit and loss, the entity would classify all its interest paid as a cash flow from financing activity. Okay, so that's just the example here. But now example 2, if an interest expense in the operating, if an entity classifies interest expense in the operating category and the financing category of the statement of profit and loss, the entity would classify all its interest paid in accordance with the accounting policy as either cash flows from operating or cash flows from financing. Okay, so this is the whole truck and trailer example. Okay, so again, whatever you've classified in terms of IFRS 18, you need to follow through on IAS 7 as well. And this is what this second example tries to explain to you. Okay. Okay, so if you look at IAS 8, so IAS 8, so the first thing that has changed in IAS 8 is actually the name. Okay, so IAS 8 used to be called changes in accounting estimates, accounting policies, and prior period errors. So now it has changed to the basis of preparation to financial statements. Okay, so the name has changed, and the reason for that is that a lot of the disclosures and requirements of IAS 1 has actually now moved into IAS 8. Okay, so the name change was the first big change, but then also the objective has changed to say that they want to enhance comparability over time with other entities. So the base of preparation needs to be consistent and comparable with other entities. So they've provided the guidance on the fair presentation. They moved it from IAS 1 into IAS 8. And that you say that you are complying with the IFRS accounting standards. And if not, there's certain disclosures that you need to present or provide when you are deviating. Okay. So, and that's the second one there. So if an entity departs from IFRS, you need to explain a lot of stuff. So you might as well just stick to IFRS, all right? Because if you are deviating, you need to still report on IFRS, but on top of IFRS, you need to explain what you have done now and what the difference is about and why it provides more useful information. Okay. Then the going concern also moved from IS1 to IS8. So you'll see that the same principles remain there. The accrual base of accounting also moved over. And then very important, the disclosure of material accounting policies. So again, talking about material accounting policies, the judgments, and all of that you need to apply. So, and again, they spoke again about what is material. So it's a material if it can reasonably expected to influence the decisions of primary users in terms of paragraph 27A until F, and consider and disclose the judgments. Okay. Then the final one is then also to disclose estimation uncertainties and assumptions. So all of this, basically is information that moved from IS1 into your IS8 standard. Okay, so it doesn't really change the what you would do, but it would, if you need to go and consult IS8 or read up on paragraphs, you will not find in IS1 anymore, but rather IS8. And it makes actually sense because it now speaks to the basis of preparation. Okay, and that's it. Okay, so that's it for the first session. All right, so yeah, it's 12:30. I said 12:30. Oh, sorry, 2:30. So I think I'm on time with that. So a little bit quicker than I wanted to go. I just want to see if there are any questions. So I'm going to open the floor if you have questions that you want to. If you have any questions relating to the presentation now.
Okay, so Milan, so should everybody come back at 22? Or you want to make it 42?
Yeah, let's make it 2:45. Yeah, maybe someone wants to grab a lunch or something quick that they can do that too. Okay, let's make it 2:45.
42. Okay, thanks everybody. Please come back at 2:45 or just before. Milan, thanks for the first session, and everybody enjoy whatever you're having now, and we'll see you in a few minutes.
Thank you. Thank you. Thank you, Stan. See you now. Bye.
Hey everyone, it's 1 minute to go. Milan will be with us in a second, and we'll continue with this next session. I don't know if we plan to finish a little earlier, but second session looms, and Milan, the floor is over to you. I hope everybody is now refreshed and ready to go.
Thank you, Stan. The first session went a lot quicker than I expected it to go. But yeah, so it's okay. I think everybody also, yeah, it's a Wednesday afternoon. It's it's been a hard year, so I think it's not necessarily a bad thing if you go a bit quicker. But anyway, I'm going to do the second session. So it's going to be on sustainability standards. Apologies, going to sip a bit of coffee in between as well, because I am aware this is the like they always say in the old CPD era, where you go to a conference venue and you get this nice tea time session, and you have cupcakes and whatever, biscuits with the coffee and the tea. Then they always call this the graveyard session. So I know what I'm in for here. So I hope you find this interesting, and I hope that you will enjoy it. So I think the topic of sustainability and ESG is very important, where everything is going in terms of the world and issues that you see, not only from an environmental perspective, but also from a social perspective. I think it's very important. So let's get cracking on this one. All right. So what I'm going to talk about in this session is I'm going to first just talk about the background to ESG and what it is, for those that would want to know about. I think everybody should be aware of ESG. And then I'm going to talk about the sustainability or ESG in South Africa. And then I'm going to talk about the ISSB standards. So my original presentation had the climate change one in there as well. I took it out, but I think if there's still time, I can just quickly speak about climate change and the disclosures regarding climate change as well. I think that would be quite useful at the end. So if there's some time left, I will quickly just add that to the presentation. I'll just send the updated slides to Danny and them if I need to make up time. Okay, because I know it, so I should be able to present it quite well. So anyway, let's talk about ESG. So what is ESG? So for me, ESG, unfortunately, for that's my personal view, is it's a slogan or acronym that has caught fire. Not for the right reasons, but also for the wrong reasons. I think, unfortunately, ESG has been regarded, or is sometimes used as a slogan as part of a company's ability to not manipulate, but to manage the perceptions of the company instead of being custodians of true sustainability. Okay, so that's my 2 cents about ESG. But ESG is a concept that comes from America and has gathered a lot of traction. I think everybody, every board meeting, especially for listed companies, they speak about ESG and ESG ratings and ESG investments and all of that, and it has kicked on quite significantly. But what is ESG? So it's about making a difference for business and the world. So it looks at a couple of things where businesses can make a difference, and that's from an environmental aspect, the E, as well as the S, the social, to create and also to create sustained outcomes that drive value and growth. So it's not only about making a difference, but also to drive growth, in basically strengthening in the environment and societies. And I think what is important here is that when you talk about the environment or the growth, is to balance it out between what is good for the environment, the E, what is good for societies, the social, but also what is good for the economy, because you can't have sustained organizations and countries if you don't have a balanced approach and you move only to a society aspect, or you move only to environmental aspect. The great example of that is if you look at South Africa, and everyone knows the crisis that Eskom had the last couple of years, and everybody, out of frustration of Eskom, that moved on green solar energy or other renewables to be able to cope with load shedding. And there's also a very strong drive now to transition from carbon-intensive organizations or economies into green economies, all right? But I think what is very important with that, and they speak about that a lot in terms of decarbonization in South Africa, they talk about a just economic, what's the word? Just energy transition, all right? So it needs to be just, it needs to be fair to everybody. So a very important concept there is that to have a just economic transition or energy transition is that you need to balance the environment, you need to balance the society impact, but you also need to balance the economy, because you need to have a strong economy. All right, and I've been hovering around on this a lot now, but I think it's so important. So that's the E and the S. But also what is important is the G. And I think that's also part of the problem of ESG, is that they see G as an outcome almost. But G shouldn't be an outcome. It should be an enabler for the E and the S and the other E, the economy, the economic aspect of the performance, to be sustainable. So for me, the governance is to be able to lead a company effectively and ethically and strategically, to be adaptable in a different or difficult environment. But for me, it's almost like it's the foundation of sustainability, and rather not an acronym as part of the ESG. Okay, I hope it makes sense. But what is also very important with ESG, it has changed the playing field in terms of accounting, where accountants have a role with ESG in terms of reporting and managing it and measuring it, but it makes it so open where there's such a wide diverse set of skills that is applied to ESG and being sustainable. So you don't only see accountants working together now. I see people in HR with accountants, with the people in strategy, with engineers, different people working together to create a sustainable ecosystem. Right. So what is very important is that an organization's ability to remain sustainable depends on resources and relationships. So everybody knows that the water, for instance, is a natural resource that we have that's not finite. So it's not infinite. It's a finite resource that can be used up, and that's the same for our natural minerals. It's the same for energy in a certain sense. Coal, we can't be relying on coal because that's something that will be used up eventually. But it's good for what we have now, but we need to be adaptable and look forward into the future. All right, but so you depend on the environment, but you also depend on your relationship within the ecosystem, how you relate with your stakeholders, your communities, your societies, and important to be able to create value in that perspective. And then also to how the organization then works with these different resources and govern it in a specific way to be sustainable. So a lot of people ask, why is ESG important and why is the information important? So it's becoming more and more important. Let's say that. And and if you look at that diagram there, you can see that the investments into greener, instruments or bonds or ESG linked companies, you can see it skyrocketed over the last couple of years. And this only goes up to 2021. It's probably even more in 2024. And I think the focus on this becomes more and more prominent as we go along, and as people realize that we live in a very complex society, complex world, business world, and there's a lot of issues that we need to resolve. Okay, and also the United Nations Sustainable Development Goals, it also links with that. So the importance to meet those goals, etc. So, and you see a lot of green investors looking at ESG as a way to broaden the portfolio of investments and look at companies differently, to have a wide scope of companies to invest in. But we've also seen some investors actually divesting or disinvesting if companies are not aligned to their needs and goals from an ESG perspective. But yeah, so something that's very important now, and it's not on the slide, but it's something that I've, through my PhD that I'm currently busy with, is what I've realized is that if you are a SME within a value chain of a bank, for instance, so a bank's purpose is to provide financing, and the bank also needs to drive a certain goal from the South African Reserve Bank and South Africa, and there's a lot of sovereign factors that plays a role here. But banks are also under pressure to be cleaner and being seen as good corporate citizens and providing sustainable finance. So if you as an entity within the value chain, a client or customer of a bank, is not thinking about these ESG factors or these the ESG information, you could be in a position where you actually price yourself out of the value chain from a competitiveness perspective. Because if this is where the world's going and you're staying on your own way of ignoring it, then you might be in a situation where you find yourself uncompetitive compared to other competitors that you have. All right, and I think that's important. For instance, banks, if I just discuss what I've seen, is that many banks say from 2025, 2026, they are not going to issue new finance that is for carbon intensive projects or loans. So for instance, if you are operating in a carbon intensive industry and you don't have a plan to move over to greener technologies, for instance, you might be in a situation where you won't get finance for new projects. So that's just where where things are going in terms of access to finance, for instance, and why ESG is important. Okay, so what is ESG? I've spoken about it from a general perspective, but let's quickly just talk again about the environmental, the social, and the governance. So from a environmental perspective, you've got your environmental aspects. Your climate change is a big part of the environmental, biodiversity, ocean temperatures I've got there, and also how you contribute to the SDGs, cleaner water, clean energy, sustainable cities, all of that from an environmental perspective, that's very important. And then also from a social perspective, what is your value to society, communities, human resources? Are we equal? How are we addressing gender equality, inequality from an economic perspective, all of that, to make sure that we create value to everybody and not only to certain parts of the ecosystem. And then the last one, the G, the governance. So it relates to ethics, good governance, transparency, accountability, compliance, and just making sure that the operations are effective. Okay, so then let's have a look at what a mining company has done on ESG. Okay, so there you can see, this is also a while back. I think if you look at reports now, you'll find better disclosures than this. But they've got an ESG framework where they talk about their purpose, their values, all right? And the values there, you can see we respect, we care, we deliver, and they want to fulfill that purpose of creating a better future. Okay. And then under each, and then in terms of the framework there, they say what is under environment, what is under social, what is under governance. And what I've spoken about on the previous slide, climate change, water, energy, air quality, waste management, biodiversity, all of that falls under environmental. Social, health and safety. For mines, it's very important, health and safety, stakeholder participation, employees, and also the mining community. And then governance, is basically everything that's supporting the outcomes also on environmental and social. Okay, so sustainability in terms of reporting and what it's all about. So I've got a quick overview that I can just share with everybody. So first of all, let's talk about global goals and principles. So we have a couple of, obviously the most evident ones will be the Sustainable Development Goals of the United Nations. And that actually stems from the Global Compact back in the early 2000s, but the Sustainable Development Goals are very, relevant now, and companies reporting on it, especially listed companies reporting on it. I work at University of Johannesburg. We also have a strong drive for, reporting and on Sustainable Development Goals and aligning it with our strategy. So that's something very big within organizations. And then in terms of other principles, the Greenhouse Gas Protocol is something that has been in existence for a while now, but the GHG protocol basically gives guidance on how to calculate GHG emissions, your carbon emissions, your greenhouse gas emissions, and just gives a framework for calculating that. Then in terms of indexes, so there's a lot of ESG indices and ratings agencies. So you've got Bloomberg, you've got Sustainalytics, there's an S&P Global. There are so many. The JSE also has their own index, and they're still not rating, but they've got the index that they also have issued. But there's so many indexes coming up, and companies reporting on these indices. Then in terms of South African regulations, you think about South Africa, what do we have? So we've got the Constitution. That's, I think, what is the most important thing here. And so what is important in the Constitution of South Africa is that everybody has a right to an environment that is not harmful to health or well-being. Okay, and that's the Constitution. So, and then everything else, comes out from the core of the Constitution. That you need to have health and safety regulations, you need to have environmental regulations, you need to have equality or biodiversity regulations. There's a lot of regulations that's in place to help with sustainability. But I think how the government has implemented them not actually effectively, and that's probably why we still sit with some significant issues in terms of sustainability as a country. Another one that I haven't listed there is the most recent climate change bill that needs to be signed into an act or when it will be implemented. But that's quite fresh and recent. So again, how you would measure your GHG emissions, scope 1, 2, and 3s. I'll probably just talk about it quickly there at the end as well. But all of that's becoming very real once this is enacted and effective as legislation. Then if you go to reporting frameworks, there are many. Okay, so we've got your integrated reporting framework, you've got GRI standards, EcoVadis has got some disclosure requirements and guidance that they give you. the TCFD that was instituted specifically for climate-related disclosures, CDSB climate disclosures also, and all of them, basically, yeah, at some stage was basically competing against each other. But what happened now recently is that many of these different frameworks start to work together, and they've, and actually form part of the new Ifrs Foundation's Ifrs sustainability standards, which actually, we're going to talk about a bit later as well. Right. But again, if I ask, ESG, what is ESG? It's, for me, it's not necessarily sustainability. So sustainability for me is a lot more than ESG. Okay, so that's why I'm asking, how does ESG link with sustainability? All right, and there, I think what is important is where we need to focus towards is the Sustainable Development Goals, and how companies are contributing to these 17 goals that has been implemented by the United Nations. Okay, so, and what I've done there is I tried to make those links with, from an ESG perspective with sustainability. So try to make the link from an environmental perspective. There we can talk about your climate action, SDG 13, life on land, life below water, good health, zero hunger can be an environmental thing, but also a social thing, which indicated this is actually very interrelated with each other. Clean water and sanitation, affordable and clean energy, all of them are environmental driven development goals. And then social. So again, there no poverty, quality education, gender equality, reduced inequalities, decent work, and economic growth, which is for me a social one, because we want to create an environment where everybody can thrive. Sustainable cities and communities also under social. It can also be seen as environmental to a certain extent. Then governance, the industry innovations, infrastructure, responsible consumption and production, strong institutions and partnerships for the goals. All right, so all 17 of them are actually can be incorporated into ESG. Okay, but I think the way we think about ESG must be, linked with the Sustainable Development Goals in mind. So I'm not sure if there are any questions. I'm happy to take a couple of questions now if there are any. All right. Okay, so let's talk about the sustainability standards. Okay, so, and I think this is something that is very exciting, it's very new, and as it stands, we're in a little bit of a limbo situation in South Africa where our government hasn't adopted the standards yet, like they have done with the normal accounting IFRS standards, incorporating it into the Companies Act and requiring companies to report on it. So maybe that will happen in the near future, but as it is currently, it's quite voluntary, from a legal perspective. But if you look at it closely, if you're not going to move towards sustainable operations and reporting on it and showing what you actually are doing towards sustainability, then you might be making yourself uncompetitive from a business perspective as well. But yeah, so let's see. I have spoken about all these different elements. I'm not going to go through it again. But the key thing is with sustainability, specifically from a reporting perspective, there were so many different frameworks, and you can do this, you can do that, and it made it very difficult to compare companies because the metrics are different. It's not consistent. It's very difficult to have a baseline for sustainability reporting. So what happened now is what the Ifrs Foundation has done is that they moved away from only accounting. Okay, so basically what they said, okay, we need to get a global baseline for sustainability disclosures. So and this all happened and I think it was COP26 or COP27, I can't remember. where they discussed the formation of the International Sustainability Standards Board. And with that, they basically said, okay, we're going to create another standards board focusing on sustainability, and we need to create a global baseline for sustainability disclosures. And also with that, what happened is that the value reporting foundations, which included the integrated reporting framework, the SASB standards, and the CDSB, that was all consolidated into the Ifrs Foundation. Okay. And what is also quite important here is, I just want to quickly just get the annotation going here again. A second. Okay, there we go. So the TCFD recommendations are very important here. So the TCFD recommendations forms the basis of the Ifrs Foundation's sustainability standards. Okay. So you will see when we go through the detail of it, the TCFD recommendations is basically the core of the standard, but then obviously adapted to incorporate wider principles as well. So the Ifrs Foundation had originally only the one side, the ISB side. The ISB was a standard setting board for the accounting standards. So from session 1, you can remember I said it's not Ifrs anymore. Now it's the Ifrs accounting standards. So the ISB is responsible for that. And then the ISSB, the International Sustainability Standards Board, they are responsible for the sustainability standards, the Ifrs sustainability standards. Okay. And they are just indicated again that, you know, the different frameworks are actually consolidated into the ISSBs or the Ifrs Foundation's structures now. Right. And basically, this is just COP26 in 2021 basically was the start of the ISSB, and where we are now is actually beyond this. So they have issued the draft and everything, but everything was actually issued last year in 2023, all the standards. So the Ifrs is one standard, which we'll talk about today, as well as the one dealing with climate change, Ifrs is 2, has been issued in 2023. So, so basically the exposure draft that was issued, which is now actually standards that is issued, is your Ifrs is 1 standard and the Ifrs is 2 standard. So the Ifrs is 1 standard on the left-hand side is almost like your IS1 standard from an accounting perspective, just giving you a basic what's the word now? A basic foundation of what is required for your disclosure from a sustainability perspective. But if you go to the Ifrs 2, then it's specifically dealing with climate-related disclosures. All right, and there's also a couple of other standards that's also in the pipeline that are working on a human capital disclosure standard, as well as the a biodiversity standard or nature-related disclosures. So there's a disclosure for that as well, and there's another one also that I can't remember exactly what it is that's in the pipeline, but there's another standard also from a sustainability perspective that they are going to look at. Okay, then if you look at Ifrs is 1. So Ifrs is 1 has qualitative characteristics similar to what the conceptual framework has and IS1 speaks to. So it basically gives you a starting point of what you want to achieve. Okay, so you want to have a situation where you provide useful information to the users of the reports. And by doing that, you want to have certain things there. So firstly, you want to have relevant information in there that is faithfully represented. Okay, so that's the core. So the same conceptual fundamental principles is existent in the Ifrs is 1 standard as well. And it's also again supported by the enhancing qualitative characteristics. So your comparability needs to be comparable. It needs to be verifiable. So it can't be stuff that you just thumb-sucked but the auditors can't verify it and can't give opinion on it. It needs to be timely and it needs to be understandable. So all of that speaks to the fact that you want to have useful information to the users of the financial statements. Okay, so if you look at IFRS is 1, the objective. So what is the objective of the standard? So the standard's objective is to require an entity to disclose information about its significant sustainability-related risks and opportunities. So very important there. So you are exposed to sustainability risks of an entity, but you also, the sustainability elements also opens up opportunities. So it's, the standard requires you to look at it from a strategic perspective as well. Okay, so it's not only accounting from a traditional sense, but it has elements of management accounting or strategic accounting implications where you need to report it from a strategic perspective. And it also requires information that is useful to the primary users of the financials, of the financial reports. Okay. And important here also is that those users have a certain context here. So the users want to assess the enterprise value and then to decide whether they want to provide resources to the entity. So that would be your banks. It will, providing capital. It could be normal investors. It can be creators as part of the value chain. So do you want to do they want to provide services to you? All right, it could be your customers. Do they want you to be part of your value chain if you are not aligned to a sustainable way of thinking? So there's a couple of things to consider from that perspective. Okay, then if you move over to the scope. So this standard is basically there to assist with the preparation and disclosure of sustainability-related financial information. Okay, and you can apply this standard when an entity is also applying the normal IFRS standards as well, and you can and also together with the financial statements that is prepared in accordance with IFRS or any other GAAP. So basically, the standard or the scope that you can apply this with is with IFRS, but also other GAAP standards, and it should be part of your normal reporting processes. It shouldn't be something separate that you just keep on the side. It needs to be together with your financial statement preparations as well. So what is also very important in the IFRS 1 standard is that you need to focus on your value chain. Okay, so your value chain it's about identifying what goes upstream in terms of what goes into your products that you are selling, but also downstream, what happens afterwards. And is that sustainable? And what risks are you exposed to within that value chain? If you look at your people that work within your company, are they effective? Are they happy? Are they in a position to create value to you? Are you fair towards them? Same with the creators. Is the process fair? And you need to think about that. Then, if you think about the value chain also, it's important to understand what is a value chain. So the IFRS 1 standard speaks about it's a full range of activities, resources, and relationships that relate to a company's business model and to the external environment in which it operates. Okay, so that's important. So it's almost, so the value chain is not only internally, but it's actually incorporates your external environment as well. Okay, and very important there, it speaks about your relationships. Okay, so it's also, stakeholders are very important as part of this process. Okay, so again, if you look at the value chain, right, and there's just a very simple way of explaining a value chain is that if you look at a product, where does it start and where does it end? So you think about a manufacturer, you purchase your raw materials, you manufacture it at a plant, you store it, and then when you're in a position to sell it, there are certain functions of selling and distribution, how it's been consumed by the customer, and what happens with the packaging, for instance, from the sustainability perspective. Is it, can it be recycled back into the system? What happens with it? All right, and that's something also very important, is the whole circular economy principles that can be applied on sustainability as well. It opens up major opportunities also for companies. But anyway, so what risks do you have? So that's what you need to consider. So in the value chain, what risks do you have? So purchase of raw materials. So you can have high carbon suppliers, which increases your CO2 emissions. All right. You can have water resources issues in terms of manufacturing. Again, your greenhouse gas emissions. Often HR practices. So it could be a situation where your HR practices aren't fair towards all employees. It could be a health and safety issue. So there's some risk that you need to address from that perspective. Storage, again, the greenhouse gas emissions. So, and again, if you have specific issues such as certain chemicals that you need to store, is it safe? Does it harm anybody? Or could it harm the community where it is stored? Or, what are you putting in place to ensure that everybody is safe? Then, from a selling and distribution perspective, again, GHG emissions, your carbon emissions there, maybe possibly losing customers due to high carbon operations. If the customers move from a carbon intensive economy to a greener economy, you might lose customers. And how do you manage that risk? And again, how do you engage with your customers, etc.? How do you change your business model, your products, and so on? Then the consumers, any consumption by the consumers, is there any negative side effects from an environmental or health perspective or whatever? And then also the destroying. So what happens with plastic wastage? How is it used? How is it managed? How do you reduce plastic wastage? How do you reduce ocean pollution? Because all of that plays with the legitimacy of you as a company. All right. But again, there are also a lot of opportunities. Okay, so you can have greener suppliers. You can have, in manufacturing, you can recycle water. There's renewable energy solutions that you can apply. You can be more effective and efficient, by incorporating new technologies. Again, renewable energy, ethically sourced products, so new products and new innovations that you can come up with from a product perspective. And also, something I haven't mentioned there is the circular economy. So again, what in my process do I usually throw away that I can probably use again? Because there's the inset. Well, what is the word? The input cost for those items that you can use again could be significantly lower than getting it again from people in your value chain. All right, so stuff like that you can consider as part of your value chain. All right, then also with the value chain, what should be disclosed? Okay, so what is important there? So very important is that you can't have a boilerplate approach to value chain disclosures. So you need to have a very company specific approach to what is your value chain and what is your business model, and to give that useful and relevant information to the users to assess the company's enterprise value from a sustainability perspective. Okay. And then also the sustainability related financial information needs to be relevant to a company who depend on many factors. Okay. And again, so make it entity specific. So what type of activities the company is engaged with? What industry are they focused on? What are type of products? What is the location of the operations? What type of employee base? What manufacturing processes? So all of that has an influence. And again, you can go back to my previous slide and thinking about, how would your value chain look like, and what specific areas is important in your value chain. All right, so then if you look at other stuff that you need to understand in terms of the IFRS 1 standard is what should be disclosed, first of all. Secondly, what is the enterprise value? So what does it relate to? Why is this important? What information is relevant to assessing enterprise value? And lastly, where and when should it be disclosed? Okay. So firstly, what should be disclosed? And again, there I'm going to talk about the detail as well, but it's all about material information and making sure that you apply materiality to the disclosures. Okay, so don't bombard the users with unnecessary disclosures. It needs to be material, and you need to be able to explain why it is material. Enterprise value, so it's a total value of an entity's equity and the net debt, and reflects expectations, amount, and timing and uncertainty of future cash flows over the short, medium, and long term. Okay, so it's a pretty much investment perspective or investment approach that you take on these on the enterprise value. So what information is important to assess enterprise value? So there it depends on different factors, but it's important here that it's not only financial information nowadays. It's also your impact from the people that you employ, or the society, how you affect the planet, but also how the economy is affected. All right. So all of those ESG factors are basically taken into account here. And when should you disclose it? So the disclosure should be part of a general purpose financial reporting. So usually it should be aligned with your financial reporting. So obviously it wouldn't be exactly the same time, and again, resources dependent. You won't always be able to do it exactly the same time, but within reasonable space from each other. Okay, so if you look about what should be disclosed in the IFRS 1 standard, there are 4 core areas that comes from the TCFD framework. So the 4 core areas would be first of all, your governance disclosures. Secondly, your strategy, your risk management, your metrics, and lastly, your metrics and targets. Okay, so like I mentioned, the TCFD is the basis for the standard, and obviously the ISSB just built on these principles and added to provide more guidance and information. Okay. So if you look at the objective of each of those core areas, so for governance is to understand the procedures, the controls, the protocols to manage the sustainability risks and opportunities. All right. So it's all about what is in place to ensure that it's well managed and monitored to be more sustainable. From a risk management perspective, so to be able to understand how companies identify, assess, monitor, and manage the risks relating to sustainability, and how it incorporates also, or how it links with other risks in the operations as well, and how it influences sustainability strategies. Then if you look at strategies, so there's again, it's to enable investors to assess the company's strategy for addressing significant sustainability-related risks and opportunities, and whether these risks are incorporated into the strategic planning of the company, including the financial planning of the company. All right, and lastly, the metrics and targets, and this is important now. So now it's about how do we measure the performance on your sustainability risks and opportunities. So which ones are you focusing on? What are the KPIs? What are the baseline years? And how are you performing compared to that? And it needs to be consistent. It needs to be measurable. It needs to be validated. It needs to be able to be validated by a specific person. All right, so this is also very important to consider. Okay, so now if you talk about governance disclosures. So governance disclosures, again, you need to disclose who's the governance body that's responsible for sustainability. And well, actually, I think you need to disclose all the governance bodies and make sure that, explain how does each body fit in. Because sometimes you have one body that deals with everything. Sometimes you have subcommittees that deal with sustainability. Maybe you have a subcommittee that only deals with climate change or risk management, and maybe it's integrated across each other. But to explain how those governance bodies are committed, or how they are structured to be able to respond to sustainability risks and opportunities. Okay, so to identify the body responsible and how the body's responsibilities are reflected in terms of reference, the mandate, and what they can do. The body, so you can't have a sustainability committee and then the people on the committee doesn't know anything about sustainability. So you need to have people that's competent and have exposure to these type of risks. And if they don't, you need to put them on training to get those skills and competencies to be able to be a bit more effective from a sustainability perspective. And then the disclosure about how often the body and its committees are informed about sustainability risks and opportunities. So how often do they meet? What do they discuss in these meetings? How do they monitor new risks and opportunities relating to sustainability? Okay. Also information about how sustainability related risks and opportunities are considered, all right, and also in how it links with your risk management and what trade-offs are made in terms of making money versus being sustainable, all right, and making sure that the users understand those trade-offs that are made. Also, the role of the governing body and its committees to oversee the setting of the targets, the targets that will, which is the fourth core area of the reporting. And then lastly, how the body and the management of the management body of the organization assesses and manages sustainability risk and opportunities. Okay, so again, you've got the board of directors, maybe you've got a subcommittee, but maybe even that subcommittee has certain roles that they delegate to other areas within the operation, and how everything actually is managed to ensure that there are enough controls in place and procedures and protocols to manage the sustainability related risks. Okay, so for a larger company, this is something that's easily implementable. Well, I won't say easy, but at least there's enough resources. But I think for smaller SMEs, this might be problematic because you only have so many people that you can rely upon and integrate into this area. So seems like there's some storms coming over here, Johannesburg. I see the trees shaking and everything, but anyway. Okay, so that's the governance disclosures. So now I'm going to quickly speak about strategy. So strategy is basically how a company that aligns themselves with the sustainability risk and opportunities, and how they plan to be a bit more effective in terms of their business model, the products, and how it will influences their outlook in the future, and the strategy and the cash flows from these changes in business models and how it will also affect their ability to attract new finance over the short, medium, and long term. Okay, so that's basically important. Okay, so the significant sustainable risks and opportunities needs to be disclosed, but also how this affects the business model and the value chain. So again, going back to what I said at the start, the focus must be on your value chain. So how does these risks affect your business model? How does it affect your value chain? All right. And there are certain disclosures that you need to provide under that as well. And then also what the effects are of the significant risks and opportunities, and how that affects your ability to make decisions within your strategy. All right, so how these effects are basically changing the way that you make decisions, and changing your business model effectively if needed, if it is a significant risk that you need to address, or if there's significant opportunities, and how you innovate to improve your sustainability from that perspective. Then also the effects of these risks and opportunities on the financial position, financial performance, and cash flow. So this is something that's very interesting. So it's not only sustainability related information and staying non-financial, it actually now goes and says, okay, you've got these sustainability risks and opportunities. How does this actually affect your financial position? How does this affect your financial performance and your cash flows? And making that link with sustainability. All right, and then last one, there is also the resilience. Okay, so again, you need to test on how resilient your company is for sustainability related risks. So it could be climate change, it could be gender equality, whatever is a key risk for you from a sustainability perspective, and how you are resilient, or how resilient your strategy is to this to the sustainability risks and opportunities. Okay. Then if we talk about the risk management aspect. Okay, so now again, you spoke about strategy, but risk management actually filters into your strategy, because you first need to understand what are your risks, how likely or how big are these risks for your company, and how do we assess these risks in the short, medium, and long term, and how do we reduce them to a certain extent. All right. So what do the companies need to disclose from a risk management perspective? So the process to identify sustainability related risks and opportunities. So that's the first one, to identify. But then also the process of actually managing the risks. All right. So how do they assess the likelihood or the impact of these risks? All right. So how do they determine whether, this is if you have a top 10 risks, this is number 11, or this is number 2, or this is number 1, how do they actually go about it? Okay. And also how the company prioritizes sustainability related risks relative to other risks in the company. So where does sustainability risk sit? For instance, again, if you look at climate change, where does climate change sit as a risk for your company compared to other business related risks? Then also the input parameters the company uses. So, what sources of information, what scope of operations is that you are covering, the assumptions that you are making for the risks that you are assessing. And and then the last one, there's also, if there are any changes from the previous year, what has changed, and why they have changed from processes in the previous year. Maybe there's a valid reason of doing it, and then you need to explain why you have applied that. Okay. Right. So if you look at risk management disclosures, so what companies usually do, they will have this matrix where they look at, the probability of the risk taking place. And there's like a scale. It's remote, unlikely, reasonable, probable, almost certain. But they also have impact. So maybe it's almost certain, but it's got a low impact, or it's minor, moderate, major, catastrophic. And then based on that, you will rate your risks. All right. So there might be in this case, what the company has disclosed is they've got an inherent risk before any controls in place or strategies in place. And the second one, the white ones, are after the mitigation is taken into account. What is the remaining risk? So you can see that they've rated a lot of them quite high as an inherent risk, but with the controls in place, they actually moved it quite down a lot. All right, and there you can get a sense of how they apply their risks, the risk management and the risk assessment of particular sustainability related risk and opportunities. Okay, but what is also important is that now I've spoken about a lot about these ones, but very important is the third bullet point there is that to what extent sustainability related risks, identification, assessment, and management is integrated into overall risk management processes of the company. So sustainability shouldn't be an isolated thing that you do on the side. It should be part of what you do as an organization. Right, so that you need to explain as part of your disclosures. And then also the extent to which sustainability related risks and opportunities are integrated into an entity's overall management processes. Okay, so how does it integrate into how you manage the entity as a whole? Okay, right. Then the final one I want to talk about is the metrics and targets. So very important here is that you need to have metrics and targets that's understandable. It needs to be consistent. It needs to be verifiable. All of those principles need to be applied here. Okay. But what the Ifrs one stand says is that the entity must identify metrics and targets that apply to all of its activities, right, in line with the business model and in relation to sustainability risk and opportunity. So it's not only financial metrics and targets, now it's related to sustainability related information. And there's certain things that will be required there, okay, depending on what those risks are. And again, it's like a funnel of information. So you start off with your risks that you identify, the strategies, but then also your how you manage the performance over these risks and opportunities. Okay, so the entity shall disclose the metrics it uses to manage and monitor sustainability risks and opportunities. So what are the metrics that you are using? Okay, so you identify it and what are them? Which of them are you using? And which metrics are you actually using to measure the progress towards the target? So what are the targets set? What are the metrics set? And how are you measuring the progress towards the target? And then very important here, when the metric has been developed by an entity, the entity shall disclose a couple of metrics. So it's important if it's developed by the entity. So the entity has developed it on its own. Sometimes you get metrics that is applied by the GRI standards, or you can get it from the SASB standards or anything else. So there might be some specific standards that you can apply. But if you developed it on your own, you need to explain how the metric is defined. So what is the absolute measure and how is it expressed in terms of the metric? For instance, revenue over floor space or whatever, or CO2 emissions for every million rand sold as part of sales or whatever. So you need to explain what the metric is and whether the measurement of the metric is validated by external bodies Okay, and if it is, you explain. So if it's validated by the auditors, you need to say it is, and if it's not, you need to say it isn't. Okay, and then also to explain the methods used to calculate the targets and the inputs. All right, so it's not only to say these are the metrics, you need to explain how it is actually how it is actually used to calculate the targets and the inputs, etc. Okay. So, and also very important there is that when you have certain targets, there's always some assumptions that you are making, or there might be some limitations to information. You need to state what those assumptions are, and also the limitations relating to these methods. Okay. Then also on metrics and targets, the entity shall also disclose the targets it has set to assess progress. Okay, so you need to say, what is my target? Okay, and specifying, what is the metrics used, the period in which the target applies, what is the base period? So what is the year that you start? Because that's very important. So some people will start the reporting on 2024. Other people will say, okay, no, but my base year is 2020. So how will that impact your performance? And what is your, in relation to your target as well? And are there any milestones or interim targets that also applies on that? Because sometimes a target, like for instance, again, CO2 emissions, there's a 2030 target, there's a 2050 target, and there are certain milestones that you want to achieve in between. Very important also is that an entity shall disclose the performance against the disclosed targets, an analysis of trends of significant changes in its performance, and also revisions that they've made. So if you have made any revisions, you need to explain why you've revised it. So maybe you lowered the target, or you made the target higher to be more comparable. Then you need to explain why you've done that. And if a metric is redefined or replaced again, you need to explain why you've made the change, why they've replaced it, why they've redefined it, why it provides more useful information, and also, like in accounting, you will have restated comparative figures. Okay, so unless it's impractical to do so. Okay, so that's also, it's like a get out of jail free card there at the end. So if it's not practical, you don't need to restate comparative figures. Okay. And again, the metrics and targets needs to be the labels that you use for the metrics and targets needs to be clear. It needs to be precise and meaningful descriptions. Okay, so it can't be just something that doesn't make sense. It needs to make sense in the context of the business. Okay. Right, so those are the four main features. So I just want to check something here. So the general features is also important. Yes. So okay. So the general features again it aligns a lot with the IS1 general features that we have. Okay. So the Ifrs accounting standards. So first of all, you want to have faithful representation of risk and opportunities. Okay, so that's important. And together with that, you have your fair presentation. You want to make sure that everything is aligned with the compliance of the standard. But also with that fair presentation is that you want to have information about your value chain. And I spoke about that earlier. So it's very important as part of your faithful representation, your fair presentation, to have that value chain information as well. Okay. Another important concept here is connected information, and I'll speak about that in in one of the slides. So, what is connected information? Why is it important? And then the general features. If you go down that list, it needs to be comparative. It needs to be there needs to be frequently reported on. Where is the location of the information? Who's the reporting entity? Sorry, I just need to move this around a bit. The use of financial data, and assumptions. So what financial data do you use? What assumptions have you applied? sources of estimation uncertainty, any errors that you might have, all right, and how you treat those errors, and also there must be a statement of compliance. So a lot of this is actually IS1 related, and that you just now apply for sustainability information. Okay, so if we look at connected information, so connected information is very important. So it provides information that enables general purpose financial reporting to assess how information about risk and opportunities linked to information in general purpose financial statements. So it's all about, you've got your financial statements on this side and you've got your sustainability reports this side. How do we ensure that this is linked? All right. And there you can see, just that diagram there. So how everything is linked: funding, risk, strategy, profitability, HR, environment, financial statements, relationship with stakeholders, everything. All of that needs to be linked and connected with each other. So it makes sense when you look at the financial statements versus the sustainability reports, that there's a story that is the same and the same risks are spoken about in the two separate reports. And an example of that would be then a company that has a production facility that generates high level of greenhouse gases. So a manufacturer, the company decides to close the facility. Okay, so from a sustainability perspective, you want to lower your GHG emissions. So the high levels of greenhouse gases you're going to reduce by closing down, but that has a financial implication. All right. So what disclosures will you have in your financial statements? So it explains the financial consequences of that decision. Okay. So, for instance, if you close down that production facility, you might have impairments, you might have accelerated depreciation, and it could have actually restructuring issues as well. So there might be, companies, staff members that need to be paid off or laid off, and there will be a restructuring provision. It could have an impact also from a social perspective, on the local community, because it employs most of the people in the local community, and then it could have a wider societal issue than just a financial decision or a GHG emission. So you need to understand the different trade-offs also between connected information of this versus the next one. Okay. Then there's another example also from the connected information. So again, if a company supplier recently found to have employment practices that fall well short of international norms, the company decides to terminate the contract with that supplier. Okay, so again, what implications will there be? There could be financial implications where the cost of its supplies could now be increased, all right, and it could have a costing implication for your inventory. Okay, it could be a situation where the cost increase, but you have an NRV reduction, so there will be possible NRV adjustments as well. Then you can also say that the new supply would be more in line with the current norms and for sustainable practices, etc. All right. So there's a couple of things, and again, these are just examples to show the way you should think from an integrated manner and applying that connectivity as part of your thinking. Okay. And then Ifrs 2, I'm not going to speak about that in detail, but I'm just going to quickly just touch on it. So if you look at the Ifrs 2 standard, so why do we have it? Okay, so it's very similar to S1, the general one, but now it's focused on climate, the implications of climate change or climate-related risks and opportunities. So you need to go and provide that information to show the effect of climate-related risks on the enterprise value of the company. Okay, and again, you follow the same approach of looking at governance, your strategy, your risk management, and your metrics and targets. Okay, so And with that, I just want to say thank you. I see this, yeah, I've ended a little bit earlier than I wanted to. I'm not sure if there's any questions from that side and whether or not I should try and keep you guys hostage for another hour or so. Please let me know.
There is a question,
don't have-
Milan.
I see there's one question. Okay.
Oh yeah, sorry, that's more to me. So yeah, there will be a recording and the slides will be sent out. Yeah.
Okay. Yeah,
Okay,
sorry, the
so-
lighting changed a little bit with the dark clouds coming over, so it looks
Yeah.
like I'm sitting in the dark here almost. But yeah, I hope everybody enjoyed the session at least. Thanks.
Yes, thank you very much. I just want to make a point that also gone green. I've just installed a solar-powered washing line, and it seems to be working well. So thank you everybody for joining. Your certificates are on the way, and we look forward to the next session, which is Jackie Arnson next month. Milan, thanks very much as usual. Very thorough presentation. I wonder if everybody's actually adhering to this green line, but let's see. And time will tell. So thank you very much. Enjoy the rest of the afternoon, and goodbye, everybody.
Thank you. Thank you.
Thanks, Milan.
Sam. Thank you, Danny. Take care, everybody.
Cheers, yeah.